headline inflation. The rationalization of the GST is likely to have a sobering impact on inflation, while at the same time stimulating consumption and growth. Tariffs, on the other hand, will moderate exports. As for the global economy, it has been more resilient than anticipated, with robust growth in the US and China. The outlook, however, remains clouded amidst elevated policy uncertainty. Inflation has remained above respective targets in some advanced economies, posing fresh challenges for central banks as they navigate the shifting growth-inflation dynamics. Financial markets have been volatile. The US dollar strengthened after the upward revision of US growth numbers for the second quarter. Treasury yields hardened recently as expectation of rate cuts by the Federal Reserve ebbed. Equities have remained buoyant across several advanced and emerging economies. I now come to the decision of the Monetary Policy Committee. The Monetary Policy Committee met on the 29th and 30th of last month and today to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. I shall now briefly set out the rationale for these decisions. The MPC observed that the overall inflation outlook has turned even more benign in the last few months due to a sharp decline in food prices and the rationalization of GST rates. The average headline inflation for this year has been consequently revised lower from 3.7%, which was projected in June, 3.1% in August, to now 2.6%. Headline inflation for Q4 this year and Q1 next year too have been revised downwards and are broadly aligned with the target despite unfavorable base effects. Core inflation for the year and Q1 next year is also expected to remain contained. The MPC also noted that growth outlook remains resilient, supported by domestic drivers, despite weak demand. It is likely to get further support from a favorable monsoon, lower inflation, monetary easing, and the salubrious impact of the recent GST reforms. However, growth continues to be below our aspirations. Even though the growth projection for the current financial year is now being revised upwards, the forward-looking projections for Q3 and beyond are expected to be slightly lower than projected earlier. This is primarily due to trade-related headwinds, despite being partially offset by the impetus provided by the recent GST reforms. Summarizing, the MPC concluded that there has been a significant moderation in inflation. Moreover, the prevailing global uncertainties and tariff-related developments are likely to decelerate growth in H2 this year and beyond. The current macroeconomic conditions and the outlook has opened up policy space for further supporting growth. However, the MPC noted that the impact of the front-loaded monetary policy actions and the recent fiscal measures is still playing out. The trade-related uncertainties are also unfolding. The MPC therefore considered it prudent to wait for the impact of policy actions to play out and for greater clarity to emerge before charting the next course of action. Accordingly, the MPC unanimously voted to keep the policy repo rate unchanged at 5.5% and also decided to retain the stance at neutral. I will now be dwelling in some detail about our assessment of growth and inflation which has gone into these MPC decisions. First of all, growth. Economic activity has remained resilient, with growth of real GDP surprising on the upside at 7.8% and GVA at 7.6% for Q1 this year. As suggested by high-frequency indicators available so far, domestic economic activity continues to sustain momentum even in Q2. Looking ahead, an above normal monsoon, good progress of Kharif sowing, and adequate reservoir levels have further strengthened prospects of agriculture and rural demand. Buoyancy in services sector coupled with steady employment conditions are supportive of demand. This is expected to get a further boost from the rationalization of GST. Rising capacity utilization, conducive financial conditions, and improving domestic demand should continue to facilitate fixed investment. However, ongoing tariff and trade policy uncertainties will impact external demand, prolonged geopolitical tensions, and volatility in international financial markets caused by risk-off sentiments of investors pose downside risks to the growth outlook. The implementation of several growth-inducing structural reforms, many of which were announced by the Honorable PM on 15th August, including the streamlining of GST, are expected to offset some of the adverse effects of the external headwinds. Taking all these factors into account, real GDP growth for this year is now projected at 6.8%. This is a revision from our earlier forecast of 6.5%. Q2 now is projected at 7%, Q3 at 6.4%, Q4 at 6.2%. Real GDP growth for Q1 next year is projected at 6.4%. The risks are evenly balanced. I will now come to inflation. Inflation conditions remained benign during 25-26 so far, with actual outcomes turning out to be significantly lower than our projections. Low inflation is primarily attributed to a sharp fall in food inflation, aided by improved supply prospects and measures taken by the government to effectively manage the supply chain. Core inflation remained largely contained, with the August reading at 4.2%. This is despite continued price pressures on precious metals like gold and silver. Turning to the inflation outlook, the progress of the southwest monsoon has been satisfactory. Healthy Kharif sowing, adequate reservoir levels, and comfortable buffer stocks of food grains should keep food prices benign. The recently implemented GST rate rationalization would also lead to a reduction in prices of several items in the CPI basket. Overall, the inflation outcome is likely to be softer than what was projected in August, primarily on account of the GST rate cuts and benign food prices. Considering all these factors, CPI inflation for this year is now projected at 2.6%, with Q2 and Q3 at 1.8%, Q4 at 4%, and Q1 next year at 4.5%. The risks are evenly balanced. I will now dwell on India's external sector position. India's current account deficit moderated in Q1 this year to $2.4 billion or 0.2% of GDP. This is in comparison to $8.6 billion or 0.9% of GDP same period last year, on account of an increased net services surplus and strong remittance receipts despite higher merchandise trade deficit. During July and August 2025, for which we have data till now, merchandise trade deficit continued to remain elevated, notwithstanding rising global trade uncertainties. India's services exports, driven by software and business services, witnessed robust growth in the last 2 months, July and August. Furthermore, robust services exports coupled with strong remittance receipts is expected to keep the current account deficit sustainable during this year. On the external financing side, net FDI reached a 38-month high in July this year, driven by increased gross FDI and a moderation in repatriation and outward FDI. Net FPI, however, recorded outflows of $3.9 billion this year so far. We have data till September 29. This is on account of both equity and debt segment outflows. As on September 26 this year, India's foreign exchange reserves stood at a healthy $700.2 billion, sufficient to cover more than 11 months of our merchandise imports. Overall, India's external sector continues to be resilient, and we remain confident of meeting our external obligations comfortably. Notwithstanding the robust domestic macroeconomic fundamentals, the rupee has witnessed some depreciation accompanied by phases of volatility. We are keeping a close watch on the movements of the rupee and will take appropriate steps as warranted. I'll now be covering the liquidity and financial market conditions in the country. System liquidity, as measured by the net position under the LAF, stood at an average daily surplus of 2.1 lakh crore rupees since the last MPC meeting in August. Going ahead, the drawing down of government cash balance and the remaining 75 basis points cut in the CRR, which was announced earlier in the remaining period of October and November, will aid the banking system liquidity in the near term. Through our two-way operations, we will actively manage liquidity to anchor the short-term rates. Money market rates have been relatively stable amidst comfortable liquidity conditions. During this easing cycle from February till August, for which we have data till now, in response to this 100 basis points cut in the policy repo rate, the weighted average lending rate of scheduled commercial banks moderated by 58 basis points for fresh rupee loans. 71 basis points is on account of the interest rate effect. The moderation for outstanding rupee loans is to the extent of 55 basis points. Similarly, on the deposit side, the weighted average domestic term deposit rate on fresh deposits declined by 106 basis points against the 100 basis points cut, while that on the outstanding deposits softened by 22 basis points over the same period. Transmission of this monetary policy has been broad-based across sectors. Going forward, adequate liquidity in the system and the remaining CRR cuts will further facilitate monetary transmission. I now give my statement on financial stability in the country. The system-level financial parameters related to capital adequacy, liquidity, asset quality, and profitability of the scheduled commercial banks continue to remain healthy. Similarly, the system-level parameters of the NBFCs too are sound, with adequate capital and improved GNPA ratios. Bank credit growth, despite being lower than last year, continues to be healthy and supportive of real economic activity. I would like to emphasize here that as other sources of funding are gradually but steadily increasing their footprint, it is the overall flow of financial resources to the economy that is more pertinent for assessing flow of funds to the productive sectors of the economy. The total flow of resources from non-bank sources to the commercial sector increased by 2.66 lakh crore this year so far, more than offsetting the decline in the non-food bank credit of about 48,000 crore rupees. I shall now come to the additional measures. I have 22 additional measures aimed at, number one, strengthening the resilience and competitiveness of the banking sector. 2, improving the flow of credit. 3, promoting ease of doing business. 4, simplifying foreign exchange management. 5, enhancing consumer satisfaction. And lastly, internationalization of the Indian rupee. First of all, I have a few measures for strengthening the resilience and competitiveness of the Indian banks. The ECL framework, the expected credit line framework of provisioning with prudential floors, is proposed to be made applicable to all scheduled commercial banks and all India financial institutions. You would recall earlier a discussion paper in this regard was issued. We propose to make these effective from 1st April 2027, therefore giving sufficient time to the regulated entities. Moreover, there will be a glide path till 2031, so effectively 5 years. This is to smoothen the one-time impact of higher provisioning, if any, on the existing books of some of the banks. Furthermore, it is proposed to make the revised Basel III capital adequacy norms effective for commercial banks again from 1st April 2027. In furtherance of this, a draft of the standardized approach for credit risk shall be issued shortly. Under the revised approach, the proposed lower risk weights on certain segments are expected to reduce the overall capital requirements, particularly for MSMEs and residential real estate, including home loans. It may be recalled that capital requirements for operational risk have already been finalized in 2023, whereas the capital requirements for market risk under Pillar 1 of the Basel III guidelines are under finalization after receipt of comments from the public. All these measures we propose to make them effective from 1st April 2027. These measures will help align our guidelines with international standards adapted to our national conditions and priorities, and strengthen the capital adequacy framework for the banks and the all India financial institutions. 3. A draft circular on forms of business and prudential regulation for investment was issued in October last year. It has now been finalized after wide public consultations, and it will be issued shortly. The proposed regulatory restriction on overlap in the businesses undertaken by a bank and its group entities is being removed from the final guidelines. The strategic allocation of business streams among various group entities of a bank will be left to the wisdom of the bank boards. It is further proposed, this is my fourth proposal in this regard, to introduce risk-based deposit insurance premium. You are aware that today we are having a flat rate of premium for all banks, irrespective of size, irrespective of risk, at 12 paisa per 100 rupees of net deposits. We propose to bring in risk-based insurance premium. This will incentivize sound risk management by banks and reduce the premium to be paid by the better rated banks. I will now announce 5 measures to improve the flow of credit to the real economy. 1. To expand the scope of capital market lending by banks, it is proposed to provide an enabling framework for Indian banks to finance acquisition by Indian corporates. Some of the acquisition finance related to infrastructure companies is already available, already provided. We propose to now expand it. 2. It is proposed to A. remove the regulatory ceiling on lending against listed debt securities, and B. enhance limits for lending by banks against shares from rupees 20 lakh to rupees 1 crore per person, and for IPO financing from rupees 10 lakh to 25 lakh rupees per person. These had not been revised for some time. 3. It is proposed to withdraw the framework introduced in 2016 that disincentivized lending by banks to specified borrowers, those borrowers which had credit limits from the banking system on the whole of rupees 10,000 crore and above. While the large exposure framework since put in place for the banks addresses credit concentration risk to a particular entity or group at an individual bank level, concentration risk at the banking system level, as and when considered necessary, will be managed through specific macroprudential tools. 4. To reduce the cost of infrastructure financing by NBFCs, it is proposed to reduce the risk weights applicable to lending by NBFCs to operational, high-quality infrastructure projects. This should give a boost to funding for infrastructure in the country. 5. Since 2004, about 20 years ago, licensing for UCBs, the urban cooperative banks, had been paused. No license has been given thereafter. Considering the positive developments in the sector, including legislative amendments in the Banking Regulation Act during the last 2 decades, and in response to the growing demand from the stakeholders, we propose to publish a discussion paper on licensing of new UCBs. I now come to measures related to ease of doing business, and we have been taking a number of measures over the recent few months and even earlier. I have 7 announcements to make, including those related to FEMA. First, a large number of circulars and directions totaling about 9,000 have been consolidated. I had earlier announced in this regard, and we have consolidated them subject-wise across 11 different types of regulated entities. Drafts of the same are ready, and they shall be issued shortly for public consultation. They should certainly aid simplification. Second, it is proposed to provide greater flexibility to banks for opening and maintaining transaction accounts of borrowers, that is current accounts, CC and OD accounts. This will particularly help borrowers which are regulated by a financial sector, for example, the NBFCs. Restrictions with regard to collection accounts are also proposed to be withdrawn. The export sector is a vital part of India's economy. To further strengthen the sector and enhance ease of doing business for them, we shall A, extend the time period for repatriation from foreign currency accounts of Indian exporters in IFSC from 1 month to 3 months. B, increase the period for forex outlay for merchanting trade transactions from 4 months to 6 months. And C, simplify the process of reconciliation of outstanding entries related to exports and imports in the respective reporting portals, the EDPMD and the IDPMS. Sixth, and these relate to FEMA, again, key provisions relating to eligible borrowers, recognized lenders, limits on borrowing, cost of borrowing, end use and reporting, etc. in the ECB regulations issued under FEMA are proposed to be rationalized. Seventh, it is proposed to rationalize FEMA regulations regarding non-residents establishing their business presence in India. I shall now state 3 consumer-centric proposals. 1. The bouquet of services offered to BSBD account holders, basic savings bank deposit account holders, without a levy of minimum balance charges, is proposed to be expanded to inter alia include digital banking, that is mobile and internet banking services. 2. The internal ombudsman mechanism is proposed to be strengthened to make grievance redressal by the regulated entities themselves more effective. 3. The RBI Ombudsman scheme is also being revised for improved grievance redressal, and at the same time we are also including the rural cooperative banks under the ambit of this scheme. Now I have 3 proposals for internationalization of the Indian rupee. We have been making steady progress in this regard. The first proposal relates to permit AD banks to lend in Indian rupees to non-residents from 3 countries, Bhutan, Nepal and Sri Lanka, for cross-border trade transactions. Second, to establish transparent reference rates for currencies of India's major trading partners to facilitate rupee-based transactions. And third, permit wider use of SRVA balances by making them eligible for investments in corporate bonds and commercial papers also. Let me now conclude. Despite an external environment that has deteriorated since the August policy, the Indian economy remains poised to register high growth. The sobering of inflation has given greater leeway for monetary policy to support growth, while compromising on the primary mandate of price stability. However, the MPC decided to wait for the cumulative impact of the recent policy actions to play out before charting the next course of action as India strives towards achieving Viksit Bharat by the centenary year of its independence. It would need the coordinated support of fiscal, monetary, regulatory, and other public policies to attain its goal. The recent rationalization of GST rates by the government is a major step in this direction. In terms of monetary policy actions, we will remain vigilant of the incoming data and stay focused on our objective of maintaining price stability while supporting growth. The various policy announcements today that we have mentioned will also support the achievement of the goal of Viksit Bharat. And in pursuit of this objective, we will be proactive, objective, and consistent in our communication while backing it up with credible actions. Thank you, Namaskar, and Jai Hind.
Well, welcome back to this Moneycontrol live stream. Of course, you heard the governor, RBI governor, on his rate action. It has been, of course, kept on hold this time around. Not much has changed in terms of the headline that has come out of the RBI policy. No rate change, and the stance has also been kept neutral. But the governor himself alluded to the fact that a lot has changed since the August policy. We saw tinkering with the growth and inflation estimates as was being expected by the street. But in terms of the rate action, it's a clear hold and no more front loading. That was the message last time as well, and the RBI has also decided to do that and see how the front loading of rate cuts that it gave out earlier this year plays out first. Going forward, of course, first of all, rate has been kept unchanged at 5.5%. Stance remains at neutral. It was a unanimous decision. The governor stressed on that as well. But he did mention that overall inflation outlook has turned more benign, and growth, of course, continues to be below their aspirations. The GDP estimate, for FY26 has been revised upwards from 6.5% to 6.8%. Well, 6.7 was what the CNBC TV18 poll was also working with, so tad higher than that poll. So 6.8%, that's where the growth forecast for FY26 is. For FY27, I think the first quarter growth forecast is at 6.4%. In terms of inflation as well, it has been brought down to 2.6% from 3.1%. And for FY27, the first quarter, 4.9%, that was the inflation forecast, but that has also been brought down to 4.5%. So I just want to understand what really the experts made of the governor's tone, because there were other slew of measures that were also announced by the governor in terms of the expected credit loss framework, a lot of other allusions or talk about changing in fact, the risk weights rather for lending to corporate India as well. So a lot of these announcements were also made to spruce up private capex. But let's put into perspective what this really means for the market. The market, in fact, is close to the day's high, 24,700. That's where we are at in terms of the Nifty. The Bank Nifty also gained strength, 0.7% kind of uptick coming in there. But without any delay, let me bring on board our guests this morning. Joining me is Vivek Kumar, economist at Quant Eco Research, and also Ambarish Baliga, market expert. Vivek, coming to you first. We've seen the governor take a wait and watch approach. Stance has also been kept neutral. That was by large what the market was really expecting. But in terms of growth forecast, inflation forecast, what do you make of it? How many more rate cuts do you see? And how would you describe the governor's tone?
Hi, thank you and good morning. Now, as the governor himself said, that a lot has changed, but in terms of the response, we saw almost no change in response broadly from the MPC. So the rates were left unchanged, and the stance also continues to remain unchanged and neutral. So what essentially it means is that so you also have to see from the perspective that the governor also said that there is space for us to ease policy further because inflation has turned benign. And there was a clear admission towards this. Now, the reason why that step for additional easing was not undertaken is because, number one, he said that the impact of past policy action are still unfolding. So this is something which he's been stressing upon for the last two policies. And that continues to remain the foremost important point that he stressed about. That action is still unfolding. The impact of CRR cut will continue to play or in fact unfold in the quarter October to December. So that's one point. The second point which he alluded to was the global uncertainty. Now here things are getting a little bit interesting because global uncertainty for India has been extremely elevated in terms of being on the wrong side of the US tariff. And we are one of the most tariff nations currently. Now, it is also true that currently the negotiations have restarted. They have commenced once again. And there is a hope that maybe by the end of December or before the end of this calendar year, you could see some resolution towards it. Now, if the 50% tariff or in fact more tariffs on several other items, whether it's goods or whether it's services, continue to come our way, then I guess the outlook on growth could see some bit of negative impact. This could then maybe prompt the MPC to take another shot at 25 basis points rate cut. Now that's one part. Now, having said so, the broader expectation is that there will be some resolution from the trade negotiations which are continuing as of now. And if those negotiations get us in terms of tariffs to where most of the other countries are, so roughly around 18-20% bracket, if that is where we finally end up with, then hopefully it will not be a completely adverse situation for India, which currently is. And in that case, maybe the knock-on impact on growth is going to be not much. In fact, there could be reasons to expect that the GST reform and the income tax relief that the government had announced earlier, along with the cyclical support from monsoon, will help the economy in the range of 6.5–7%. That's what the broader expectation is from the policymaker as well as from the market participants. So net-net, I think it's the governor realizes that, in fact, not just the governor, I would say the entire MPC realized that the inflation which is being projected 4 quarters down the line is pretty much close to where the target is. And the room for additional easing is limited. So as long as that limited room exists, you might probably want to use it when the situation becomes extremely dire and keep it as an insurance for the daily day.
Got your point. That was the read through then. But coming to Ambarish, what's your read through? The markets were looking for some kind of positive signal from the governor. Do you think we've got it? Because the market reaction has been fairly strong. We are near the day's high. What is your assessment?
Yeah, because I think most of the people had not really expected a rate cut. I think most of us are talking about rates remaining the same. And even that was my expectation. Because, see, one aim of the monetary policy is to be an economic booster. But since the government had already taken steps to boost consumption via that GST 2, I think RBI, I mean, made sense in keeping this ammunition for the next monetary policy. So if I'm talking of the balance of the financial year, I see the 50 bips cut going ahead. And clearly, we have raised the GDP forecast. The inflation forecast is benign, basically because of the food inflation, because that's down. And I mean, I expect that to remain so, looking at the good monsoon season we have had. So I think overall, the policy was more on expected lines. So because of which I think we have seen this decent, I mean, bounce back in the market because we've been down for the last 8 days now.
Yeah. Yeah, point taken. Yeah, we've been down for the last 8 days. So hopefully we will be ending the day as well, snapping out of an 8-day losing streak. But gentlemen, hold that thought. I'll come back to you again. But joining me once again is Hamsini. Hamsini, of course, you heard what the experts said, more or less on expected lines, but there were a lot of other announcements in terms of banking, right? ECL, the expected
Yes.
credit limit, plus reduced weights for NBFCs to lend to corporate India for infrastructure as
Yes,
well.
yes.
That comes as a big boost, right?
Yes.
Because at a time when there's no rate cut being rolled out, but he's also given a message that, see, we really want to encourage private capex at the same time.
Absolutely.
So Nifty Bank Index is, rejoicing.
It's on fire.
It's on fire. It's
Yeah,
at the day's
yeah,
high.
yeah.
So tell us from a banking perspective, what has this policy done?
October policy should be remembered by bankers as a policy meant for banking industry, because a lot of concessions, exemptions, relaxations with the industry has been seeking for a very long time. The most popular one today would be the DICGC cover, right? Link it to the strength of the banks. That will free up a lot of cost of deposits for the banking, for large banks like top rated banks like HDFC, ICICI, which have the best of ratings, SBI. Treating them at par with some of the smaller banks does add up to the cost of deposits. That's a great move. Likewise, at FIBAC, we saw SBI chairman come out and say that, allow us to participate in a more meaningful manner in acquisition financing. There has been some, we have to look into the finer print on that, but there's definitely going to be some traction on that. ECL norms are going to come in play, and we're going to have a good 5-year window, glide paths to deal with norms. The major relaxation, again, we need to see the fine print, but one of the major good things that has also happened today is bank investments in subsidiaries, non-lending and lending subsidiaries. It has been left now, basis what the governor said, to the discretion of banks as to how much money they want to keep in subsidiaries. There will not be any there may not be any straight-jacketed ways of saying that this is what is doable, this is not doable, and so on. That's if that does translate into fine print, it's a great thing. It's a pro-bankers MPC. At a policy level, yes, I was thinking that we would see some amount of front-loading of rates. That's not happened. A couple of minutes from now, we'll understand in finer detail what was the rationale that went through in that to withhold any rate action. This policy do we see a deferment to the next policy in December or thereafter? We'll know all of that at 12 o'clock's press conference. But having said that, this time around, if you notice, Nandita, his language was a lot more watchful, a lot more cautious on aspects such as tariff and cross-border movement. Last time he did expect some sort of easing to come up on those fronts, which has not happened. So how is he going to respond to this is another thing that we'll have to watch out for. Net, reiterating, it's not so much a markets policy or anything. It's status quo from that perspective, and which is also partly resulting in the equities losing their 7-day losing streak, which is good. It was in the green, at least the last I checked, and as you pointed out, Bank Nifty is on a
it's kind of leading the
momentum.
way,
Yeah. So policy action beyond, I think we'll have to look beyond the headline number
Sure.
of repo rate.
That's why quite a few other measures to boost credit to the economy
Yes.
and of course encourage private capex as
Yes.
well. But what is that one question that you would be asking the RBI Governor at 12 p.m.?
Why did he, revise GDP estimates upwards?
6.7 was something we were working with. He's
Yes.
done it to
6.8.
6.8. So is that a little...
What is the MPC seeing that we are not, immediately seeing at the moment?
Perhaps he went with the fact that, of course, if you do the math, at least the last quarter was much, much above estimates, which automatically bumps up for the quarter.
Yeah,
the
it
GDP figures. I
resets
think
the
because
base.
of the arithmetic.
Yes.
That's my guess.
Yes, yes. And has the MPC somewhat taken into account the revenue losses possibly to the government because of the GST impact? Okay. The informal number that a lot of us are going with is 48,000 crores. What is it factoring in for that as well in its deficit data? Okay. We had a very reassuring statement by the governor that, the forex reserves are healthy for the next 11 months of our forex spending. So that's a good one. He did seem a little cautious though on the rupee movement. He said that whenever required, we will intervene and we are keeping a close watch on that. So macros, he is aware that it is evolving at this point in time, and should we expect, what sort of further commentary we should expect from the governor on the macro front? We'll know that in about an hour or so from now. But this is a great policy, one that I don't think a lot of us expected. It had a lot of goodies for the banking sector.
Sure. Thanks, Hamsini. I will not keep you waiting anymore because you have to proceed to the press conference as well. But our experts are waiting. And I want to come in, get in Vivek. Vivek, what are your thoughts on the 6.8% figure in terms of the upward revision in GDP and the 4.5% figure for the first quarter of FY27 in terms of CPI? Should he have brought it down a little more? What does this combination indicate? Does it sound a little hawkish to you?
Well, not really. Actually, if you see on the inflation bit, you can probably assume that they've now taken into account the impact of GST rate cut, which will be much more visible as we move forward. So GST rate cut probably in the next 2 or 3 months, you will see a period of adjustment, and thereafter you will see the actual impact trickling down to the larger basket of goods and services in the economy. So for me, Q1 coming down by almost 40 basis points in terms of CPI inflation forecast, to a large extent, takes that on board now. Now, as far as GDP growth forecast is concerned, now here something to note is that the current forecast revision, which has been upward, is predominantly an exercise of doing a mark to market with respect to what has happened as far as Q1 GDP growth is concerned, because that was a clear positive surprise. It was a surprise not just for market participants, even the policymakers were surprised positively. So that is now taken on board. Now, if you strip that out, so if you strip the impact of Q1 GDP growth from the full year number, or in fact look at the 4 quarters ahead GDP growth forecast, it's actually a tad lower. So this is something which also the governor said, that if you look at the H2 growth numbers which they are forecasting now, it's actually lower than what they were forecasting in the previous policy review in August. So yes, to a large extent, there is an upward revision for the full year number on GDP growth, but that reflects the very strong unanticipated data that came out in Q1. And incrementally, the numbers are actually lower than what they were in August. So from a hawkish, dovish perspective, it's marginally dovish rather than dovish.
Okay, got your point. Ambarish, now let's talk about banks. My colleague Hamsini was saying it's a complete pro-banking policy. Would you agree with that? Because quite a few announcements to that effect. First of all, the ECL framework comes into effect from the 1st of April 2027. Right. Then he also spoke about risk-based deposit insurance premium to reduce costs for better rated banks, and she mentioned a slew of banks, the top rated ones, HDFC, ICICI also get, and also the ambit of acquisition finance to be expanded. How are you looking at these announcements, and in terms of private to PSU, where should one look at? Taking into account all these announcements, what are your thoughts on the overall banking space now?
No, I think these announcements are positive for the larger banks with, a better credit rating. And in fact, I would be more positive on the PSU banking space because overall, what I see over the next 12 to 18 months is that we'll have a consolidation among the PSU banks. And I think we could be down to about 5 to 7 banks overall. And the ones which will remain with the same name clearly are SBI, PNB, Bank of Baroda, and Canara Bank. So these are the ones where I think I would be decently positive on from a long-term perspective, despite the fact that we have seen some movement in these stocks already.
Yeah, that's true. PSU banks have once again become the darlings of the market, especially at a time when the markets have been following. We have seen PSU bank index gaining 2%, consecutively, Monday, Tuesday, etc. But Vivek, at your own organization, Quant Eco Research, what are you factoring in terms of inflation forecast, especially since the new base, CPI base, comes into effect from February 2026? How does that really impact the near-term trajectory for inflation going forward?
So that's very difficult to do because that's an exercise which happens almost once in a decade by the finance ministry, in fact, the government, the statistical ministry to be precise. So it's difficult to take that into account because we don't know what is the scope of expansion of the CPI basket. We don't know how, we have a sense of in which direction the weights are likely to move. But in terms of the expansion of the coverage of the CPI basket, that is extremely hard to guess. So we'll see when we come to the bridge and we'll come to the river and we'll decide how to cross it. But as of now, we are bang on as far as the RBI's estimate is concerned on 2.6% CPI. So on the current base, we are looking at a 2.6% CPI for the current financial year.
Okay, and for the first quarter of FY27, would you be close to RBI's projection of 4.5% as well?
So we are slightly lower than that. I would probably keep it at 4.2, 4.3.
4.2, 4.3. Okay. I want to come to you now, Ambarish. In terms of private capex, I want to pose a question on NBFCs because the governor did announce the fact that there will be reduced risk weightages for NBFC lending for infrastructure development as well. Do you see private capex picking up? That has been a pain point, but now with demand side reforms coming in, companies would like to expand capacities. So does this come by as a very positive move, especially since there's been no rate cut that was rolled out this time around? And because of that, which kind of NBFC should one look at?
No, in fact, this should be positive, no doubt. But then the way I see it is the private capex may start picking up maybe the next 1 or 2 quarters, not immediately, because what we are seeing is because of GST, the consumption boost has happened. But we need to see whether it continues or whether this is going to be only a 2 to 3 month sort of a phenomena. So if that continues longer, which is again my expectation, then we should actually see private capex increasing going ahead.
Okay, that's the view. And what about autos? Today, autos are also in focus. Ambarish, sales figures have been trickling in, and Bajaj Auto, I think I saw that was pretty good. M&M also came out. How do you think one should play autos? Because a lot of this up move related to GST pickup, has already happened in terms of stock price movement at least. Where are we in that cycle, auto up cycle right now?
No, see, that's already played out to a certain extent. I mean, what we have seen in the past couple of weeks, since the past month and a half, was a sentiment playing out. But from today onwards, what we are seeing is the numbers will play out because the numbers have just started flowing in as far as the auto sales are concerned. I think over the next 1 or 2 months, we'll start seeing the numbers play out. Because whatever said and done, people had delayed their buying despite the festive season setting in. people had delayed their buying because of the GST cut coming in. And some of the automakers had announced a GST, sort of a discount much earlier. So I think from that point of view, we have seen some amount of sales already coming in September. But October, November, I think we'll see more amount of sales coming in as far as the auto space is concerned, and the numbers should look better. So as of now, I would still stay invested, and in case of some correction, surely should be looking to buy into the auto space, especially two-wheelers and the passenger car side.
All right, as of now, stay invested. Of course, October, November, sales figures expected to be much better from here on. But coming to Vivek now, Vivek, how are you looking at how the bond markets have really received the governor's commentary? I think the yields dropped somewhere around 2 basis points or thereabouts. Do you think the bond markets are happy with really with what the governor has done? And since the last policy, the June policy, in fact, not last, the June policy, we've seen yields tick up higher despite front loading of rate cuts. What is your trajectory when it comes to the 10-year yields going forward as well?
So going into the policy, we were expecting one last round of rate cut from the RBI, in fact, the MPC. But that hasn't come about. And in fact, while the broader market was expecting a status quo, there were sections in the market who were calling for maybe one more 25 basis points rate cut. So the way the bond market has reacted, I see as of now, yields are up by about 3-4 basis points. So that probably reflects that minor disappointment, because few in the market were expecting a 25 basis point cut. And 10-year yield, I think somewhere close to now is at 6.59, 6.6%. And that with a repo rate at 5% is a little bit on the higher side. And in fact, if you compare how things were in June, there has been, as you rightly said, there has been a clear widening of this term premium vis-a-vis the 10-year security. So in some sense, the bond market has reacted adversely, and that to a large extent reflects all the front loading that happened, the sudden change in shift, the sudden shift in the policy stance, as well as the expectation that all the support which the fiscal policy is now trying to provide will also have some bit of repercussions on the fiscal side. Although the government from the finance ministry side especially, they have come out on many occasions and said that the fiscal deficit is going to be maintained at 4.4% of GDP. But nevertheless, I guess there is some bit of anxiety with respect to the state of fiscal affairs. And last but not the least, in fact, I would probably say this is the most important item, is the fact that it's not just the central government, the state governments are also facing fiscal pressure, because what yields are showing is a culmination of what the center as well as the states put together are doing. There has been an increase in state level borrowing, and since state level borrowings are eligible for SLR maintenance, so they kind of compete with the government securities, the demand for government securities. But the only silver lining in all this is that the foreigners, the FPIs, continue to be net buyers, which is unlike the equity segment where we are seeing constant outflows, but FPIs have been continuous buyers of our local debt for the last 3-4 months. That has been the only support factor. So looking at where things stand now and looking at the very guarded comment from the governor as far as the rate trajectory is concerned, it is possible that a great amount of decline in the bond yields probably will not come about, because all the liquidity infusion which is also going to happen is going to happen through the CRR route. So that limits the space for the central bank to come out in the market and start purchasing bonds to infuse liquidity.
Okay, so that's how the trajectory for bond yields looks like going forward. Last couple of questions really. Ambarish, coming to you for real estate, this pocket has been hammered. There has been demand concerns.
Right.
We've seen the realty index shed over 20%, stark underperformance. Do you expect some kind of revival after so much pain? How should one look at real estate now?
No, the issue is that most of the listed stocks have a lot of inventory in the premium segment. Whereas what we are seeing is there's a
Yeah.
demand for affordable and low-cost housing, and there has always been a demand in the super premium range. So from a listed entity's point of view, yes, I mean this problem is there, and I think it's going to continue for a while longer. But then I think one should be looking at those stocks. I mean, who have more exposure to the affordable housing space. I think that's what is going to, I mean, continue doing well. And also because of the GST cut, as far as cement is concerned, more than helping the cement companies, it's actually helping the affordable housing companies because they're like as a percentage of the construction cost. I mean, cement, although I mean, we can talk about 25, 30 rupees per square feet is the actual cost reduction because of GST. Even that has been positive for the affordable housing space. So I think that's the space we looked at.
Okay, look at affordable housing when it comes to the entire real estate gamut. Vivek, what about the currency? The governor rather did allude to the fact that they will, be watchful if there is too much volatility. There could be some intervention there, but at this rate, should we be comfortable given the fact that it is providing some cushion from the tariff blow, right? How much should the RBI let the rupee weaken here on? Is there too much space for that? No.
So it's a valid question at this in this environment, and the movement in currency reflects the pressure on current account balance as of now, and it's an idiosyncratic pressure. So we'll have to first distinguish between what's macroeconomic and what's idiosyncratic. So from a macroeconomic perspective, one probably has every reason to argue for currency strength. Uh, Look at the growth numbers in the vicinity of 6.5% broadly. And that's probably true that India is one of the fastest growing large economies in the world. Inflation is projected to remain below target for the next 4 quarters on an average basis, and even beyond the 4 quarters, it's not expected to be significantly higher than the target. So we are looking at a very healthy growth inflation balance. Our fiscal deficit has been correcting pretty sharply has corrected pretty sharply in the last 4 years. It is expected to consolidate even further. The ratings upgrade has happened in once in maybe 2 decades or maybe 3 decades. That kind of move that we've seen. So there are macro fundamental reasons to expect the currency to strengthen. However, in the current environment, uh, we are uh, we are facing an idiosyncratic risk on the current account deficit, all because of the tariff situation. Now, the rupee response is nothing but an adjustment mechanism to this shock that has come about. To some extent, it is desirable because we would want that adjustment to take place. If, let's say, that the tariff, even if one has to ignore the penalty tariff of 25%, and just look at the 25% tariff, the reciprocal tariff, which has been imposed on India, so that's about 5 to 6% higher than most of our peers. So in some sense, the currency has to adjust somewhat to reflect this tariff differential of 6%. So in our sense, what we are seeing right now is this adjustment mechanism playing out. Uh, the good part is that it is happening at a gradual pace. So it's not that volatility levels have gone through the roof and corporates have been caught off guard. So it has happened in a steady and a gradual manner. And does it cause any inflation risk in the near term? Since we are at a situation where inflation is already undershooting our target by a fair margin, the inflation risk, even if it were to materialize, it will be onboarded and it would be very comfortable the economy would be in a very comfortable position to absorb that inflation risk. So it's desirable. Our forecast on dollar rupee is for a level of 89.5. We are probably inching towards that. And a 5% depreciation on INR would by and large be a good adjustment mechanism to neutralize the tariff differential that we
Okay, got your point. Ambrish, then last question to you really. What's the scope of rate cuts from here? Do you see one more in the system in this easing cycle? Because there are a few reports I read where a 50 basis point is being baked in. Where do you stand?
In fact, I just mentioned that possibly going ahead, we should see another 50 basis points cut. But then this time, like I said, since something was already done by the government, I think the RBI governor felt it right to keep the ammunition for future rate cuts. So I think going ahead, 50 basis points is what I'm looking at.
Okay, and Vivek, I think you said 25, if I'm not mistaken.
Correct. So we do still believe that there is space for another 25 basis points.
Sure, got your point. With that, gentlemen, we've come to the end of this live stream. Would like to thank you for taking out time and joining in and sharing your thoughts with us. Look forward to chatting again in the future, and of course, taking this opportunity to wish you guys a very happy festive season, a happy Dussehra in advance. I think some bit of an uptick in the market, so that would be good news for the equity guys. Ambarish, thank you guys for taking out time. Thank you for joining in.